Hey, everybody, whether you're watching this now and join me today or later, we're going to continue down the path of me just kind of sharing with you the questions I'm being asked, things that are coming up as I talk to those looking to build wealth through real estate or buy their first home here in the spring of 2025 here in Denver. I'm going to start with a little bit different today with my journey going into building wealth through real estate. And then I will end with a handful of things that I was asked about and the current state of rates, because as I said last week, things are volatile. So hang tight. But let's first go back in time, a handful of years into this business, and I decided it was time to buy a home. Well, how did that happen? I actually wasn't planning to buy a house, to be honest with you. I was at a closing with a real estate friend, and she explained how she had a house that she thought one of her buyers should buy. The buyer decided not to buy it. And she said, it's a great house. It would be a great investment. So the reason I bring this up is this ended up becoming a house hack. Now, mind you, this was at a time when nobody was house hacking or talking about it. This would have been 2005. Okay. So here I was, young into this business, didn't have a lot of money saved, didn't actually have a plan about when I was going to buy a house. So I didn't know enough to know how to get out of my own way. What happened? Well, I closed on the home. I rented out the basement. I'm going to flash forward to save a little bit of time on this story. I always knew I was going to develop the house, but here came the housing crisis. As I was working through this industry, I had bought a rental in 2006. So there I was living in my primary residence, renting out the basement, and had bought a rental, renting out that home. Now, mind you, that home was not bringing in cash flow. And I know for a lot of people looking to buy rentals, it's all about if it doesn't cash flow, I don't know if I want to do it. None of this is meant to pat myself on the back because nobody can see the future to know what was going to happen. I still own that rental property. That rental property is paid off. So what am I getting at there? What I'm getting at is the reality became that I totally undershot what would happen to rent over time on that property. Nowadays, you could look up this data online for what you can expect for payment changes if you buy a property that you do then rent out. So here we are, it's 2006. I own my primary, renting out the basement. So I'm offsetting that mortgage payment, and I have a rental property as well. Then that was my now wife. And in 2008, that house became a rental. So we now have 3 houses. And that property we moved into in 2008. Now, mind you, what was happening in 2008? That was the housing crisis, right? So I bought a house that was a foreclosure at a time when home prices were plummeting. Okay. They were physically plummeting, not like what you're seeing right now where home price corrections are happening. Prices are coming down. One of the things that came up this week for me was Jay Powell, and I forget his first name, but the founder of PayPal, Thiel, talking about this fundamental problem that we have regarding the housing market and why we've got a problem. And that is there just isn't supply. Jay Powell said this back in September of 24. The problem will become we don't have enough houses. Okay, so here we are back to 2006, then to 2008. Bought that house, started remodeling it while we lived in there, known as building sweat equity. We did most of the work. I sacrificed a lot of time with friends on the weekends, etc. And I did that back in 2006 when I bought that rental as well. I'll just kind of go through this part of the story relatively quick for you. What became of those days? Flash forward, 2 kiddos, and we moved out of the house that was the home we renovated while we lived in, remodeled, etc. But what did we do before we moved out of that house? I used equity on the home, took out a home equity line of credit or HELOC, and bought a property in Breckenridge, Colorado. If you've skied there, you know. If you hear of Vail Resorts, Breckenridge is one of the major mountains in Vail Resorts. Needless to say, this many years later, that property is a high-performing short-term rental. Keep flashing forward in my life, and here we are. We now have another high-performing short-term rental outside of Denver, about 45 minutes. So why does any of this even matter? it's not that it matters per se, but it's the psychology of money and the relationship for these decisions that we're making. If I'm going to be honest with you, when I bought this last short term rental, it was after I thought the sole plan is to pay off the debt. So I did pay off one rental, paid aggressively down on the other short term mortgage. There's about 10 years remaining in it. And then my relationship with money changed. So if you're wrestling with that thought of buying your first home, you have to think about what is it that's actually holding you back right now. One question I like to ask people to start with is, do you believe in homeownership? Because if the answer to that is a clear, definitive yes, then you've already crossed that hurdle. If you're not sure if homeownership is right for you, then stay renting until you better know. After that, it becomes where I've seen clients save substantial amounts of money. Now, when I go back to that time in 2005, I had $20,000 saved. I had credit card debt as well. I had student loans. I had a car payment. I made a disciplined choice to put less money down on the home and pay off those credit cards. As a result, I looked at it simply from the position of, I'm not going to go charge up these credit cards. Now, mind you, I didn't have children at that time, but being financially disciplined, I ultimately decided that money was better served paying off the credit cards. The $400 a month credit card payments I was making resulted in a $100 higher mortgage payment. The net, $300. So I improved my personal cash flow by $300 a month. Now, also at a time when I talked about renting out the basement, what did I do? I offset a higher cost of living. This is going to sound whack to you. I was paying $300 a month in rent. My mortgage became $1,800, so 6x. Okay, so did I have to wrestle with what am I going to do with this increased cost of living? Yes, I did at that time. And how I chose to do it was sacrificing some of the space that I knew, quite honestly, I didn't need the space, but I wanted a single family residence. The home that I bought in 2006, I ultimately knew at that moment I would develop the home because of the zoning allowed for duplex to be built. Flash forward 2025, handful of years ago, that home had been built into a duplex and sold as well. So additional decisions that I had to go through was more recently with the short-term rental that I acquired. This was after a time that I knew the sole plan was pay off all the debt, be debt-free. That's the mindset. Why would I have that mindset? I'm just going to be honest with you. Growing up in a household where money was mismanaged, watching a father go bankrupt multiple times, having cars repossessed, never did they lose the house, but going through all those other financial hardships, eating government cheese, if you know those blocks of cheese that came in cardboard, powdered milk, etc. Growing up, my relationship with money is something that I'm coming to peace with now from at that time in my life. But I always believe in homeownership. I knew I was going to buy a house. And what I also believed in is that I saw it as a vertical of wealth. And the reason that I say that is just simply this: being in this industry, being self-employed, owning a mortgage company, I don't have a pension. It's that simple. Yes, we have a 401k here. I've created that for the team, but I don't have a pension to fall back on. And I still, although I'm going to be 50 this year, I don't believe in Social Security. I don't know that it will be there. If it is there, great, but I didn't put it in my list of income for retirement to be reliant upon Social Security to retire from. So I knew I had to create wealth, had to take some risks. Now, currently at this time, with 3 properties that are rentals and our home, I know one thing: those houses, if paid off, will yield retirement income. Does it mean that we're just living the life of luxury? No, it doesn't. Does it mean that I stress about the finances? It does. The reality becomes, though, is simply this. Over time, and I've shared this with you in prior videos, lives, etc. What I can say is the data supports real estate goes up in value. Colorado Q1 in 1980, Q1 of 2020. I've shared the chart, 4.55% appreciation. with 7 recessions, which include the housing crisis. Okay, that's when I bought multiple homes at that time when houses were plummeting in value. There were thousands of homes in the market, people were losing their houses, etc. But I simply knew that I wanted to have property. If you're thinking that real estate will become a part of your retirement, if you rate it high on your portfolio for income, residual income into the future, wealth, net worth, etc., maybe your first home isn't the dream home. That first home of mine was 800 square feet that I lived in. I rented out the basement. So well below what I thought I should have, rather recognizing what I needed because I wasn't going to be there on the weekends. I was going to be snowboarding. I was going to be with my friends, although I did want a single family. Okay. But if I was in a place now with cost of housing today and I had money saved for a down payment, because I am seeing first time buyers typically have more money saved for down payments than I had the ability to save back then. So, what am I getting at? What I'm simply getting at is maybe it's a reframe of the space you're going to move into because it's not going to be your forever home. If it's going to become a rental, there's always going to be a need for affordable housing. What do I mean by that? Well, if I ended up buying a condo or a townhome because that allowed me to have a sustainable payment relative to what I'm paying in rent today in a city like, say, Denver, where average rent can be north of $2,000 a month. Maybe I have a townhome or a condo, but my dream was the single family. However, cash flowing in the near term future on a property like that, breaking even, etc., will be much more achievable than a single family in a city where if you bought an average single family home in Denver right now and it became a rental, you're maybe getting 40 cents on the dollar, meaning for the cost of the real estate versus the rent, you're not achieving the old adage of the 1-to-1, cost rent ratio. Those days are gone. However, what's not gone is sustained by what Jay Powell said, Mr. Thiel said about the fundamental problem we have with real estate stock in America, therefore causing home prices to continue to go up. So think about where you want to wake up in 5 years. And if you do believe in owning real estate, I will say this: are you willing to make sacrifices? I did. If I look at where I'm at now from where I was at then, and if I asked myself then, do you think you'll be here in 2025? I would have said F no. I didn't take as many risks as maybe looking back I should have. There's deals I passed up on for different reasons, whether internally, mentally, or not. But I took some, and taking some has yielded me a position where I may be blessed. Aside from catastrophic financial events, my children. Now, whatever you think about those who invest in real estate, that's your choice. But for my children, my anchor of why I continue to grind, the goal is simple: to put them in a place in life in the future so that they have financial stability, because I feel for Alpha Gen. That generation is going to have a tough time owning homes, and it's very possible they're renting those houses they own until they pass away, because the cost of real estate into the future will be exorbitantly high. If you take the 4 decades of time in Denver, 4.55%. Look at that property you're interested in right now. 10 years from now, 45.5% more. Add that to the price, and that's just decades of data. Again, that's not here being put out there to tell you you should do something. That's not. You have to be the one that feels the timing is right. You have to believe in it. It has to be affordable. I talked about that on the last live. So let's talk about some things relating to that. If you like this video, make sure to check out more. There's a whole library of educational videos to help you grow wealth through real estate. Schedule time, calendly.com/mortgage maestro if you want to talk about everything I just discussed. Now let's talk about the top 5 things that I was asked this week from people like you who are in Denver getting pre-approved to buy houses in the spring of 2025. First thing, which was really interesting, came up yesterday. This is somebody who collectively they have a sizable amount of money saved for a down payment. They make good money, college educated, etc. So just building out the framework, nothing more than that for you, okay? And they asked me, Ray, should we go direct to the seller to buy the house? My brother said if we do that, we can save money, we could be in a better position, and we might get the selling agent to help us get our deal accepted. So it's a very valid question. Those of you that are aware of this real estate settlement, the NAR settlement from 2024, it is something that's out there. What you got to ask yourself is, do you have the time? But then more so, I asked them to challenge their thinking. And the reason I said that is I'm not to say you should or shouldn't. Real estate agents, definitely the really good ones are worth their weight in gold, just simply are. How long has the selling agent known the seller? I will just ask you that question, because then you got to think about allegiances. You got to think about where are they going to be trying to do the best for and buy, right? As it relates to that. So from that, hey, Ray, will we get a better deal if we go direct to the seller? Well, let's be honest. There's actually already an agreement pre-existing on how much the seller will pay in total in commission to sell their home, subdivided out by how much to a buyer agent and the selling agent. So it's not to say you're going to save money necessarily. My opinion is, if you're thinking about that, do more research, ask questions, and then decide if you should go direct to the seller. This one is very easy to answer, but it did come up, and it comes up actually quite a bit. I'm kind of surprised, but I think it's because we're now in a time where people who are buying had family members that probably bought at times when there were prepayment penalties. So the common question becomes, are there prepayment penalties on the mortgage? And the answer to that is, if you're doing a standard mortgage for your primary residence, they are not allowed. If you're an investor qualifying off the debt servicing, or that known as that DSCR loan, it's pretty much the standard, okay? So loan specific, but rest assured, if you're a primary resident buying a home using a traditional mortgage, you're looking at, on average, a 30-year fixed, but there are not prepayment penalties, okay? Somebody then asked, what do I do about the thought of putting extra money to the mortgage every month? So with that, I can say this, because they talked about budgeting. They talked about being able to make the payment in a timely fashion. And Ray, does it pay down the house faster? It's pretty clear. It's pretty easy. You can Google this stuff, but it's referred to more commonly as a biweekly mortgage. Okay. So if you're paid 26 times a year biweekly, this can really help you for budgeting purposes. You would end up having half your payment taken out of your account, and therefore one extra payment per year is what happens in that example. Okay. What does that do to the mortgage? In short order, if you send one extra payment a year, and the numbers are not far off if you do just a 13th payment, or if you do it every 2 weeks, that you're going to send one extra payment a year. The principal is applied after the interest is paid for that month. Therefore, the numbers work out very closely between doing it biweekly or one extra payment a year. And that is, you will save about 4.5 to 5 years on the life of your loan. Bear in mind, though, are you going to live there that long? It can be, in my opinion, a forced savings plan, because you're paying the loan down faster. Therefore, even if you sell in 5 years, 7 years, 3 years, you will owe less. Therefore, your payoff will be less, and you will walk with more proceeds. So if you like the idea of a quote unquote forced savings, it's a great concept. Yes, you will pay less interest over the life of the loan, and over time, less interest per month, because you are paying more to principal. And an amortized mortgage, that's how they work as well. So from there, they said, if we're pre-approved for X and we want to buy a house that's more expensive, what does that mean? Does that mean we just put extra money down? And the answer to that is yes. And it's almost like it takes a quick second to think through this, because if you're approved for a loan amount of $450,000, and let's say that's based surely off debt ratios, the reality becomes, if the loan does not change from 450 If you just put an extra 50 grand down, the house price can go up $50,000. Of course, the question becomes, what is the best use of that money? And if it is, as they said, to maintain our lifestyle, right, we simply just like to go out to dinner, by all means. If that money is better served so that you can maintain the lifestyle with vacations, great dinners out, going out, etc., to live in this beautiful state that we call home here in Colorado, ski weekends, which are expensive, then by all means, put the extra money down. But think through what is the highest and best use of that money. I could stake a challenging thought to that argument, to challenge someone's thinking about it of just put the 50 grand in the bank, draw interest off of it, low risk investment, and then subsidize, because it's about $250, $300 a month higher in payment. 300 divided by 50 grand, that's a lot of months that you could, in fact, have that money earning interest for you versus just putting it down on the house, therefore working in another vertical for you to grow some wealth through interest earned if you were investing the money. So what is the opportunity cost of putting that extra money down so that you maintain the same mortgage payment? So what I'm getting at there is what I've talked about before. So check back prior videos about what I would call the subsidization of lifestyle, which is related to putting more money down to maintain the same payment versus putting that money in the bank and then just transferring the delta every month for the mortgage payment. So those things there. And now let's talk about the direction of interest rates since last week when I talked about this. And here we are. The CPI, the inflation report, came out this week, and we are seeing some very interesting trends relating to mortgage rates as a result of what happened. And that is, I'm not going to share the chart right now because I was having some trouble with screen shares here on live, but the last 2 days, today included, mortgage bonds are rallying. I think between today and yesterday, we're almost 100 basis points. That doesn't mean interest rates have come down 1%, y'all, but it's a dramatic change. What's most interesting about this is now we're seeing, and actually I'll have these guys pin a chart here. Now we're seeing that we might see a run, and I'm thinking about this as the hangover effect. What do I mean by the hangover effect? Simply that the hangover effect, I said 8 out of the last 10 years, mortgage rates had gone down this time of year, and this year they did not. However, May of 24, rates went down up until October. So is it just delayed? And this most recent inflationary data is going to cause mortgage rates to come down? Time will tell. So stay tuned there. If there's anything specific that you want me to talk about, definitely. If you want to have a conversation, callaway.com/mortgage maestro. Make sure to check out other videos we have on the channel. I'm constantly updating the information. The current theme is bringing to you those questions most asked, most pressing that people are thinking about, kind of akin to a Google search, but knowing that it's coming from someone talking to many home buyers every day. Be well. We'll talk to you soon.